Though it may seem far away, a good retirement is something we all look forward to. Some of us dream of spending more time with friends and family, going on adventures, or relaxing on the boat. However you plan to spend your retirement, saving for it is important and sometimes confusing. Your 401k is a valuable tool for building your nest egg. Let's take a few minutes to discuss how contributions to the 401k work. Because your 401k money is entitled to special tax treatment, the U.S. government has placed limits on how much money can go into your plan each year. The most important limit is how much money can go into your 401k plan in total each year from any source. For 2021, the overall limit is $58,000. Most years, the IRS changes contribution limits, so we suggest reviewing these limits at the link below to review the current year's numbers. Put simply, there are three sources of money for funding your 401k plan. The first is your elective deferral contribution, or what Empower calls your standard contribution. This is money that you elect to have come out of your paycheck for which you receive an income tax benefit. Standard contributions are either pre-tax or Roth, or some combination of the two. For 2021, the IRS allows you to defer $19,500 of your income into your 401k. If you're under age 50, your standard contributions stop automatically when reaching either the $19,500 deferral limit or the overall $58,000 limit. If you're age 50 or older this year, you can contribute more money to the plan regardless of the $19,500 elective deferral limit or the $58,000 limit. This is called catch-up, and for 2021, it's $6,500 of additional money. If you're eligible for catch-up and you reach one of those limits, your standard contributions will automatically go towards your catch-up. They will stop automatically after putting the additional $6,500 into catch-up. The second source of money you can contribute is after-tax contributions. This is also payroll deducted, but it's not treated the same for income tax purposes as standard deferrals are. Therefore, there's no deferral limit on how much of this kind of money you can put in. It is only limited by the overall $58,000 limit. These contributions stop automatically when reaching the overall limit. The third source of money is the CBA-mandated 16% company contribution. This is 16% of your eligible earnings that the company sets aside for your benefit. The portion that goes into your 401k applies to the overall $58,000 limit, like your payroll-deducted funds do. It also has its own IRS limit based on how much you make. When the company puts money into your 401k, it can only take a certain amount, your eligible earnings, into account. This is called compensation limit, which is $290,000 for 2021. There are some nuances to the way the company's 16% is distributed. More on that in a moment. Unlike your payroll-deducted contributions, the company's 16% contribution never stops. It only changes destinations. At first, it goes into your 401k. When your 401k fills up by reaching the overall $58,000 limit, it goes into the CBA-mandated trust, known as the Voluntary Employees Beneficiary Association, or VEBA, which you can use for medical expenses after you retire or leave the company. When you reach $290,000 in eligible earnings, it goes into your paycheck. Now, let's put it all together, starting with the first paycheck in January, when you haven't contributed towards any limit yet. Each paycheck produces one or more contributions. In most cases, your 401k receives these contributions concurrently according to your elections or the CBA. Your standard contribution, if you elect to make one, goes towards the $19,500 limit and the overall $58,000 limit. After-tax contributions, if elected, and the company's 16% go towards the overall $58,000 limit too. Keep in mind, as you approach the overall $58,000 limit, the order of contributions will become important. In that case, The fund would receive contributions first from your elected or standard contributions, then from your after-tax contributions, and finally, from the CBA company required 16% contribution. The same happens with the second paycheck and the third, and so on. And this will continue until the end of the year or until you hit one of the limits. Suppose you hit the $19,500 deferral limit before any of the others. Your standard contribution stops flowing into the 401k towards the overall limit, but the other two sources continue. If you're eligible for catch-up, your standard will continue until catch-up is full. We'll mention later what happens if you hit the overall limit first. If you're a high earner, there's a potential unintended outcome you should be aware of. If you reach the overall $58,000 limit before reaching your $19,500 deferral limit, your standard contributions will stop, even if you intend to make your full contribution. If eligible, your standard contributions would start going towards your catch-up earlier than you may have expected. It is important to stay aware throughout the year of how close you are to the IRS limit if you want to avoid this outcome. Retirement planning strategies can vary from person to person. We highly recommend sitting down with a financial advisor you trust to discuss the investing options that are best for you. If you ever have any questions, please feel free to contact the JetBlue ALPA Retirement and Insurance Committee. We are always here to help.